Hello, everyone. Thank you so much for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation and a couple of housekeeping notes about this webinar. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries either during the webinar if it relates to that particular part of the webinar or during our Q&A period at the end of the session. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. We're happy to reach out to you after today's event to make sure that question gets addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our speaker today and welcome him back. Josh Stamer serves as a Senior Managing Director for the West Region at Foundation Source, working with wealth managers, financial advisors, attorneys, and donors who either have or are interested in establishing a private foundation. He has extensive experience in both financial and client services. Prior to Foundation Source, Josh was the Western Regional Sales Director with Workiva, formerly Web Filings, where he successfully onboarded and developed client partnerships with some of the nation's largest banks, insurance companies, and mutual and hedge fund organizations. Josh graduated magna cum laude from California State University, Long Beach, and from the University of Wollongong in New South Wales, Australia, where he focused on business management. And Josh, I will tell our viewers that this is the second webinar that you've done with us, and that you did a more like one-on-one sort of charitable giving where we talked about private foundations and other charitable giving opportunities before. And I will say that our viewers are welcome to find that on our website. That's in the webinar section of our website. But today we're going to get a little more in the weeds and dig into some of the more advanced charitable giving. So I'm really excited to have you present, and I'll turn the time over to you.
Terrific. Thank you, Marche. It's a pleasure to be back. I think you said something in one of our prep sessions about delivering education as related to helping advisors be more knowledgeable in creating the conversations with their clients. And that's really what we're here to talk about today.
And we would be talking to donors as well today, so not just advisors, but also people who are interested in engaging with advisors.
Absolutely, absolutely. And I think the most important thing to remember is also something that you alluded to, that this is going to be unique to everyone. And what we're here today is to share some strategies. You mentioned that our first session was a little bit more charitable giving 101. This is going to be exploring some additional strategies around private foundation giving that could be thought of as a little bit more advanced. So we'll walk through a little bit of a background on Foundation Source and who we are and how we work with our clients and advisors. So we're going into our 22nd year. We're currently administering a little over 20 now billion in foundation assets, working with about 2,000 private, family, and corporate foundations across the U.S. We do, that does make us the largest signer of private foundation tax returns in the country. So we're coming to this conversation from a place of expertise and experience. We only work with private, family, and corporate foundations. So we do not work with donor advised funds. We don't work with charitable trusts. We don't work with public charities or really any other type of charitable giving vehicles. So we are laser focused in working with private, family, and corporate foundations. But many of our clients leverage many different strategies, and that's one of the things that we're going to talk about today. So for the agenda today, Marche, we talked about the best way to approach this topic, and thought it would be appropriate to start with the vision, right? So talk a little bit through charting a philanthropic course and making a plan. When you've come to the point of making the decision for you, your family, your company, about formalizing your charitable giving, maybe taking the next step from what we often refer to as checkbook philanthropy, or supporting the causes, people, et cetera, that you care about with monetary gifts or volunteer hours, or supporting them in a more direct way. But taking that next step and creating a formalized charitable vehicle, what are some of the things that you should think about in creating a plan? Next, we'll talk about a few example strategies. We're gonna dive a little bit further into the first one, more so than the others, because I think that's an area where we see an incredible amount of interest, and that's really taking a diversified charitable approach and exploring the different types of charitable giving vehicles that are available for people. Most notably private foundations and donor advised funds, because those really tend to be the largest and most accessible of the charitable giving vehicles out there. Not to say that other charitable giving vehicles are not as important, but we're going to talk a little bit about differences between private foundations and donor advised funds. Not, as you mentioned, really in the weeds, because we could do a completely separate presentation on just that topic, but we will spend a good amount of time talking through private foundations and donor advised funds, differences, similarities, how they can be used independently, how they can be used together, etc. And next, we'll talk about 4 strategies that are more specific to private foundations, and we'll touch on a few case studies of where we've seen clients leverage these strategies in a successful and meaningful way. We'll talk about leveraging charitable expenses. We'll talk about understanding international giving. We'll talk about exploring program-related investments. And then finally, we'll talk through granting to individuals through either scholarships or hardship and support type grants. So that'll be our agenda for today, and we'll jump right in by talking through charting a philanthropic course. So the majority of time when we think about kind of starting at the top, right? You're a family, you're a corporation, you've made the decision where you're going to explore setting up a structured charitable vehicle, be it a private foundation, a donor advised fund, et cetera. What are some of the things that we often find and help clients think through? First is at the top is really identifying motivations. What's causing you to get to this place where you feel led to take that next step and create a formalized charitable vehicle? Next would be deciding what you care about. And then finally, exploring charitable options that are available to you, be it specific vehicles, as we talked about before, or maybe specific strategies that you're going to look through or consider when you're moving to a charitable vehicle. So deciding what you care about, again, we've talked about it before, it's going to be very personal and individualized. However, some of the areas that in general that we see are what you're finding on your slide here. So many times people, individuals, corporations, families will focus on big challenges, things like poverty, disease, racial equality, education, climate change, et cetera. Sometimes they'll focus in a more specific manner. They'll look to things like prevention care for pregnant women, early childhood development, water conservation, getting a little bit more specific about the goals that they want to achieve. Populations, who are they going to potentially appeal to? Lots of folks feel led to work specifically with children or with a specific ethnic group, or many times it's animals, followed by places. Are we going to limit our charitable giving and our focus to within the United States? Are we going to broaden that out to the world? Are we going to be more specific to a specific state, city, neighborhood, et cetera? And then finally, what are the types of institutions that we're potentially exploring working with? Are we going to work directly with individuals, as you can do with a private foundation? Are we going to work with other institutions like public charities, museums, orchestras, universities, et cetera? So when we think about deciding what you care about, these are some of the motivators that we take from our clients as kind of a subset of of the general philanthropic population.
We do have a question here. Did you
Sure.
see uh, over the lockdowns and over COVID, did you see an uptick in charitable giving to more medical causes or research for that?
We did. I think that anything that's going on in the world is specifically going to drive an increased sense of awareness um, for the different issues that are out there. Obviously, we're coming through a pandemic here. We've seen several natural disasters unfold, but it's not always just the negative things that people are looking to curb, right? They're many times looking at something positive that's going on in the world and trying to continue that, right? We've seen absolutely incredible advances in the medical community, and people are looking to take something that's going right often and further advance that. I think a lot of times we get a little bit stuck on some of the bad things that are going on in the world and wanting to curb that or combat that or fight that. But a lot of times people are just as in tune with furthering things that are going on the positive as well. And I think that's important to remember.
That's very cool. Thank you.
Absolutely. So next, we'll talk a little bit about exploring charitable giving options. So we talked about at the top the ability to move maybe from a more traditional approach to philanthropy, which is writing checks to your favorite charities or working directly with organizations that you're passionate about, to actually making something a little bit more formal through maybe a charitable remainder trust or a charitable lead trust. These are terrific vehicles that I would encourage people to speak to their advisors about. They can have their own merits and benefits, but predominantly the two that we see most commonly deployed are both donor advised funds and private foundations. So let's move through kind of that introductory area and talk a little bit about those two specific vehicles, Marche, of private foundations and donor advised funds. Maybe starting with some of the similarities of the two, right? So as you'll see on your screen here, private foundations both generate a current year income tax deduction for charitable gifts. The reason that this topic is so particularly pertinent in the second half of the year for many clients is because they have clients and advisors collaboratively have a better sense of what your adjusted gross income is going to be for that year. And many times people feel like they can get the best bang for their buck by contributing portions of their income toward the end of the year from a tax leverage standpoint, in addition to wanting to focus on the causes that they care most about. So it's very important, as you mentioned beginning on, to always make sure you're consulting your team of professionals, consulting your tax advisor, for example, consulting your wealth advisor, consulting your attorney before you make the determination of creating and funding any charitable giving asset, because as we know, specific to private foundations and donor advised funds, contributions are irrevocable, right? Once you make that contribution, you can't say, "Oh, wait, just kidding. I only want to do half of what I thought I was going to do initially." So it's important to have those conversations. Both private foundations and donor advised funds have many of the same advantages when it comes to avoiding capital gains or contributing and becoming exempt from gift and estate taxes. They certainly have different limitations. We'll talk a little bit about that here in a couple of slides. But many of the overarching strategies, both from a philanthropic standpoint and a tax minimization standpoint, are applicable to both private foundations and donor advised funds. Okay, so let's talk, Marche, a little bit about the difference between the structures of donor advised funds and private foundations. So one of the important things to note is that donor advised funds are technically an account that's housed within a public charity. So we typically see different types of donor advised fund sponsorships. Many are directly through a financial institution. Many are through community foundations that have a little bit more of a direct community feel. And then others are served through national donor advised fund sponsorship organizations. You can start out as little as, again, depending on the organization that you're partnering with, as little as $5,000 for starting a donor advised fund. And for many people, they're really an entree into the formalized charitable giving space. Private foundation, from a structural standpoint, is quite a bit different. You're talking about an independent legal entity that is governed by an individual, a family, a business. It has its own board. It has its own tax ID number established. does file for tax-exempt status directly with the IRS. And I think that last bullet point there is very interesting, because a lot of people automatically hear the word private foundation and assume that this is going to be a very large, massive entity. But currently, 66% of all private foundations in the U.S. have around $1 million, or maybe a little bit less than $1 million in total assets. So it has become a vehicle that's much more accessible to more people at a lower entry point.
I have a question here. Is a private foundation its own, does it qualify as its own business?
Yeah, so it's a good question. Private foundations are actually set up in two ways. They can be set up as a corporation or as a trust. They can also be domiciled in any state. So one of the really important considerations when you're exploring establishing a private foundation is determining, is it going to be better created for you and your family or your business as a corporation, or is it going to be better off served as a trust? And then also considering which state of domicile is going to be the best fit for you and your family. That's not necessarily always specific to where you live. You could have board members that live in 5 or 6 different states, right? So those are important considerations to talk through with your professional advisors.
All right, let's talk about the different kind of considerations that you've listed here.
Sure. So the next consideration when you're speaking about private foundations and donor advised funds that's most important, in my opinion, is control. So donor advised funds, while they are very easy to establish and they're fairly inexpensive in overall consideration of things, they do come with some limitations from a control standpoint, meaning that donors, just like the name implies, they're advising on the distributions made out of these vehicles. So they don't directly fully control the distributions made out of donor advised funds, but they're then making recommendations or advising the donor advised fund sponsor on how they would like to make those distributions. Donors recommend an investment selection to its governing board. Each named advisor can act independently to recommend gifts. And from a perpetuity standpoint, many donor advised funds, not all, because many different donor advised funds act differently, but typically have limitations on the successorship of that vehicle. Whereas private foundations, it's going to be a little bit more control driven. So the donor determines the governance and the structure and the bylaws. So the individuals, the family members, the corporation is in complete control of all of these items. They're also maintain complete control over the grant making and the investment decisions for the foundation. So they can invest in typically a broader range of investment options within a private foundation. And private foundations can exist into perpetuity. So many, I would say the majority of private foundations, the idea is that you're moving one board to the next generation within a family or a corporation, and then the next generation becomes more involved. So it gives a lot of people a sense of legacy in deploying a private foundation.
All right, so I did have a question here about the successorship of advisors in the donor advised fund.
Sure.
So typically you're saying that the original donor would be the advisor, but say their children or other people they would like to carry that on, that's not necessarily something that can happen in a donor advised fund.
So it can. This is something that is going to be a little bit dependent on the structure and the donor advised fund sponsoring organization in determining how that successorship is placed. Some donor advised funds do allow for children to take on a donor advised fund. Other donor advised funds recommend a spend down. So it's really important to kind of consider if you're moving forward with a donor advised fund, what that plan is going to be, because it can be a little bit different than a private foundation where you're typically naming a successor or even a second successor who might be your children or friends and family members, trusted professional, et cetera. So again, don't want to get too specific on donor advised funds because I'm not an expert, but this is something that you'll want to have that conversation prior to understanding what that looks like. So
what I think you're saying here is that you need to think about not only, what's going to happen during your life, but also what will happen after you pass with those goals that you put forward.
Absolutely. And I think on the next slide, actually, Marcia will talk a little bit more about that.
Great.
Yeah, no problem. So from a grant making standpoint, donor advised funds, the vast majority of the work they're doing is distributions directly to US based 501c3 public charities. I've often heard donor advised funds referred to as charitable checking accounts because you're advising on how those distributions are made, but there is certainly some limitations on who those distributions can ultimately end up with. Donor advised funds, again, are very easy to work through, but they can be a little bit more limiting on the distribution side. Private foundations, by contrast, are going to allow for a much more flexibility when it comes to the grant making side. You're not going to be limited to just US-based 501c3 public charities. You're going to be able to include international grants or grants directly to individuals, or creating scholarship programs, or in many cases, running your own programs and programmatic work within the construct of the private foundation. Along with this does come a minimum distribution requirement, and we'll touch on this in a follow-on slide as well. But it's important to note that private foundations do have a requirement when it comes to the amount that's distributed out of the vehicle every year. Some donor advised fund sponsors do mandate that through their own organization, but at a national level, they're not required to have a minimum distribution requirement in the eyes of the IRS like a private foundation does. Okay, so this is something that you just kind of touched on a moment ago, Marche, and the convertibility piece. I think the most important consideration when it comes to a donor selecting a private foundation or a donor advised fund, or any charitable vehicle for that matter, is not necessarily what's going to affect their decision now, but what's going to affect their decision and their goals down the line, right? We know that both vehicles are receiving irrevocable contributions from a contribution standpoint. However, donor advised funds really have rules in place that make it all but impossible for moving assets from a donor advised fund to a private foundation. Whereas because a donor advised fund, as we mentioned before, is an account held within a public charity, private foundations can grant to public charities anytime they want. So you can move assets from a private foundation to a donor advised fund, but you really can't move assets from a donor advised fund to a private foundation. And to your point, why that's important, not just now, but for all time, is because if you choose a vehicle that is in line with your philanthropic mission now, you really need to make sure that it's that philanthropic mission is not largely going to divert over time. I've had many people come to me and say, hey Josh, all of our philanthropic work is done supporting US-based 501c3 public charities anyway. So why would I consider a private foundation? And I often have to tell them, that's your goal today. Is that going to be your goal in 5 years, in 10 years? Maybe when the corpus of that endowment is 2, 3, 5 times what it is now. How do you know you're not going to want to consider exploring setting up a scholarship program, or giving internationally, or running your own program? What if 10 years, 20 years down the line, one of your grandchildren comes to you and says, hey, I have this absolutely amazing program that I'd like to run directly and facilitate as a part of our family philanthropy? You can be a little bit more limited if you've front-loaded a vehicle like a donor advised fund, and now you can't move those assets over to something like a private foundation that's going to be a little bit more flexible and control driven. So again, it really comes down to taking an approach of asking those questions and making the determinations ahead of time. So reasons to explore a donor advised fund. Again, typically if you're looking to start with a lower entry point when it comes to an initial contribution, a donor advised fund's maybe going to be a better place to start. Average size of a donor advised fund in the US is I believe, currently about $20,000 in assets. Now, there's certainly, you can start lower, as we talked about before, and many are much, much larger. However, the average size of a private foundation is going to be typically around that $1 million mark. So when you are considering, it shouldn't completely drive the amount of assets that you're considering, should not completely drive which vehicle you consider. However, it should be a consideration. Again, donor advised funds are typically exclusively giving and making support grants to US-based public charities. There's not as much concern over perpetuity or this existing for a legacy purpose. Donor advised funds do allow for complete anonymity because they do not file a tax return with the IRS, so they can give knowing that, again, typically to US-based public charities, but there's not a lot of information out there about who the grants are going to. And then sometimes it's a really good strategy if you're considering funding with real estate or appreciated personal property due to tax treatment. there's an advantage to contributing to a donor advised fund over a private foundation, because you're not going to be limited to a lesser of cost-based or stepped-up deduction. With a donor advised fund, for different asset classes, it can be advantageous because you're able to take a stepped-up deduction when it comes to taxes. Again, always have the consideration of speaking through with your tax professional. And then by contrast, some of the reasons why you might consider a private foundation. So again, full ownership and control, your ability to run your own board. You're looking for more control and flexibility, both short-term and long-term, in your philanthropic goals. And then there's some other items listed on the screen here, but I try to make it not a best practice to read everything on the screen here in front of us, Marcia. So we can move along. So the next strategy I love to talk through is the fact that the vast majority of philanthropists who have gotten to the point of formalizing a private foundation tend to also explore having both a private foundation and a donor advised fund. And there's some very specific reasons why leveraging both vehicles can be very advantageous for many philanthropists and many donors. So private foundations, as we mentioned before, they do file an annual tax return. So one way for a private foundation to also keep maybe more of their giving anonymous is to use a donor advised fund as a thoroughfare. So they can make a gift from their private foundation to their donor advised fund and have the donor advised fund ultimately make that gift. If there is areas of sensitivity that a donor doesn't necessarily want out there and maybe wants to explore funding an organization that's outside the mission of the private foundation, or a family member is passionate about, or a one-time grant that's really not going to be continued in the future, a donor advised fund as a thoroughfare for a private foundation gift can be very advantageous.
And so just a clarification here.
Yeah.
So like you were saying that the private foundation can allocate funds to a donor advised fund. So
Correct.
this would be that strategy.
Absolutely. Absolutely. Yeah. And in fact, I mentioned before Foundation Source, my organization supports about 2,000 private family foundations, and a good percentage of those foundations, probably in excess of 50% at this point, also utilize a donor advised fund. So it is becoming a very commonly leveraged strategy to have both vehicles, right? When you think about it, many people want a diversified financial portfolio. Many people are now getting to the point where they want a diversified philanthropic portfolio in that same breath. So avoiding mission drift, I touched on this a moment ago, but the ability to maybe make a grant from a private foundation to a donor advised fund because something that you want to support is not technically within the direct reach of that private foundation, using a donor advised fund as an intermediary can be very helpful. We have some foundation clients that have had a very direct and specific mission for a very long time, right? Maybe they're set up, it's the XYZ Family Foundation for Pediatric Cancer. And that's in the name of the foundation, and it's in the mission statement. And then maybe somebody associated with that family is felt or is led to make a support grant outside of that pediatric cancer space. So instead of maybe having an effect on the overall mission of the foundation, they can make that gift to a donor advised fund and then have the donor advised fund ultimately thoroughfare make that gift for them. So another reason to potentially explore having both is, as we talked about before, private foundations have what's called a minimum distribution requirement, meaning that it's typically 5% based on the prior year's average assets in the foundation. But private foundations are required to report on and make a specific amount of distribution every year. Making gifts from a private foundation to a donor advised fund, even if you're the controlling interest of both of those, does satisfy that 5% minimum distribution requirement. So real world example here, Marche, might be you have a private foundation, it's late in the year, you still have 2 or 3% of your corpus to distribute. You're on the fence on some of the issue areas that you'd like to contribute to, so you don't want to make any ill-informed gifts just because you want to hit your 5% distribution requirement. You could end up using your donor advised fund as an overflow valve and say, hey, I'm going to gift this other 2 or 3% to my donor advised fund. That way I buy myself a little bit of extra time, not making in any ill-informed gifts. You're still satisfying the distribution requirement of the private foundation. You're still remaining compliant in the eyes of the IRS, but you're not having to leverage that right away. Perfect. So At this point, Marche, I think that, as I mentioned before, we'll move out of the private foundation and donor advised fund conversation a little bit and move into the next phase of the webinar here. I always encourage people to continue the conversation when it comes to private foundations and donor advised funds and any formalized charitable vehicle, because of what I said before, right? Some of them do not allow for movement of assets between the two, and it's the most important consideration in funding one versus the other. So certainly continue to do your own research, continue to ask questions of your advisory teams, et cetera. So the next strategy that I'd love to talk about is more specific to a private foundation, and that's the ability to leverage charitable expenses in line with a philanthropic mission. We talked again about minimum distribution requirements, but what a lot of people don't understand is that 5% minimum distribution requirement for a private foundation is not necessarily just your grant-making budget, right? It's a distribution requirement, not a grant-making directive. So one of the biggest benefits to a private foundation is that you can leverage charitable expenses directly in line with the charitable mission. Now, a lot of people automatically assume that charitable expenses means, paying my kids or paying staff or something of that nature, but that's really not the majority of the expenses that we see leveraged out of a private foundation. So this next slide, this explores maybe a couple of items that we see some of our clients explore and some very large foundations deploy who are looking for ways to be a little bit more direct in their support outside of your standard grant making applications. The top one is one of my favorites, right? This is the ability to hire issue experts and specialists in your field of interest to make sure that when you're to the point of making a large grant or a contribution out of the foundation, you're doing so in a way that creates the most impact and fulfillment to you as a donor. So this might be hiring somebody who understands a very specific community issue to go out and explore who's already doing work in this space, and can we piggyback on some of the work that they're already doing, or are we going to maybe need to explore creating our own program before doing that? You can pay these types of expenses out of the private foundation, and it counts really the exact same as a grant making dollar would in the foundation. The next example is another favorite of mine, and that's the ability to facilitate and pay for site visits out of a private foundation. A lot of my clients really feel that if they can go and sit down and have a meeting with somebody at a public charity, could be across the country, it could be in a different country, to really understand how that impact is, or how their gift is going to be used to create the most impact. It's really important to be able to not be limited in your work by not being able to pay for these types of expenses out of the private foundation. So it can be a very good use of foundation funds. Again, making sure that it's not being exploited, it's staying within the direction of the IRS. However, being able to leverage foundation expenses for that type of work is very important. In that same vein, attending conferences and continuing education on issues. I have some clients here where I'm based in California that travel every year to the East Coast to attend an education seminar, and it's their favorite because they get to continue to learn about what's new in the marketplace specific to the issues that they care about, and they pay for those expenses as an expense of the foundation. They can join peer network. They can retain specialists for legal counsel. We have clients that want to explore naming opportunities with universities and other buildings in line with the gifts that they're making, and you can pay for legal counsel and specialists as a direct charitable expense of the foundation. In addition, as I mentioned, that last bullet point, to providing reasonable and necessary compensation for either staff members or family members who are going to be taking a very direct role in some of the things within the foundation. So I'll close that piece. You can tell I get a little bit passionate about exploring charitable expenses, just because I think it's one of the maybe more underutilized standpoints within a private foundation or charitable giving in general, is the ability to really leverage expenses in line with the philanthropic mission. So the next piece that we'll discuss is international giving, right? One of the additional benefits of a private foundation is that you can give directly to international organizations that you're passionate about, that are within the mission of the foundation. Okay, so let's talk a little bit about the ways that private foundations can give directly to or indirectly to international organizations and support issues and agenda items that are outside of the US. So the first and maybe the most straightforward way is utilizing what we call a Friends of organization, right? So this is typically a program that's being run outside of the US, but it has direct ties to a 501c3 public charity based here in the US, or they have multiple offices. Many times you can explore a direct gift to that US-based 501c3 charitable organization that has an office here in the US, and then ultimately those funds and that support is sent off to another educational institution, religious organization, et cetera, in another country. It can be very straightforward and easy for the private foundation because in essence, you're making a direct grant to a US organization, and then ultimately partnering with an organization to facilitate that ultimate goal. The next one is a process utilizing a process called expenditure responsibility. So expenditure responsibility is a process, is really a compliance process that allows for an extra layer of due diligence to explore and make sure that an international based organization who's not directly partnered with a US based entity is acting in accordance with a philanthropic mindset or would otherwise be considered a US-based 501c3 public charity had they applied for that status here in the US. So leveraging a process called expenditure responsibility is a way that US-based private family and corporate foundations can give directly to international organizations, not going through a Friends of organization. There is typically an additional fee associated with making an expenditure responsibility grant because you're paying for that extra layer of due diligence to be performed to make sure that you're in compliance. But it's a way that's continuing to gain, continuing to grow within the marketplace. And then the final way is utilizing a third process called equivalency determination. So equivalency determination, we predominantly see equivalency determination also similar to expenditure responsibility, but equivalency determination many times is utilized when there's going to be an ongoing support of an international organization, right? It's an organization based in another country that you as a donor are going to support multiple times a year for multiple grants. This is usually a process of an attorney or another expert doing a study on an organization and in essence rubber stamping that organization and making sure that then they can make grants to them on an ongoing basis. So there are organizations out there that will retain a database of these types of organizations that are allowed to, that private foundations are allowed to make direct gifts to. NGO Source is one that comes kind of to the top of mind, but there are other organizations out there as well that'll help with the equivalency determination process. These are things that we do help our clients with directly at Foundation Source, but it has gained a lot of steam within the private foundation community and continues to do so as we have more international interests here in the US. All right, so the next topic we're going to talk through, or we're going to highlight, again, this is one of those ones that we could spend an hour and multiple hours talking as far as a direct presentation, but program-related investments. You often see it abbreviated as PRIs. There's a lot of folks in the philanthropic community that really believe that program-related investments are a big part of the future of charitable giving. Typically, there's three types of program-related investments. And again, I'll also point out, Marche, that this is a really important area to talk through with a qualified wealth advisor, because a lot of this is pertaining not just to the grant-making budget of a private foundation, but also the investment budget within a private foundation. Now, a lot of people feel like if they can align the investments and the programmatic work or the grant-making work with a private foundation, that's really the best way to create the most impact and fulfillment within a private foundation. However, you do want to make sure that you're discussing strategies with a qualified professional before making these types of investments. So program-related investments, there's three varieties. There's program-related investment loans, there's program-related investment loan guarantees, and then finally program-related equity investments. And we're not going to dive into the specifics of each, but again, a lot of folks feel like if they can leverage a program-related investment loan within their private foundation, it's going to allow them to get more impact and fulfillment as a return. So just as an example, think about maybe a donor specifically does a lot of work with with a medical clinic that's based here in the US, and it's a small localized medical clinic, and they need a new roof on that building, their offices, and a private foundation can make a program related loan or a program related investment loan, help pay for that new roof to be put on that charitable organization. And maybe they do it at a 0 or a 1% rate, right? So it's kind of the best of both worlds. The charity is getting to be able to pay for something, not have to take on that interest rate. So really, the gift that the program or that the private foundation is making is while it ultimately is going to get paid back to them, they're creating an incredible amount of benefit by removing that from that charitable organization. So program related investments do have to be focused on the actual philanthropic mission. They can't be set up for the explicit purpose of creating a financial return. That's kind of the biggest rule for private foundation program related investments. However, when leveraged and utilized the right way, program related investments, namely loans and equity investments, which would allow a donor to take an equity stake in a for-profit business that has a philanthropic focus to it, they're being more and more widely leveraged and utilized within the private foundation community. So definitely an area of continued exploration there.
That's really neat. Never thought about that. That is a little more advanced thinking about doing those loans and the investments.
It is.
Very
It is.
interesting.
It is. And we hear the hot button very often of kind of impact investing, right? And impact investing, in my opinion, kind of means something different to everyone. Impact investing for some folks can mean, hey, I'm doing impact investing because I'm making sure that, I care about health-related issues. So I want to make sure that my investment portfolio aligns with that care and discretion. Other people will make their investments with organizations that are only positively focused on certain areas. And they both kind of fall into that impact investment bucket. This is a way to really leverage impact type of investing within the construct of a private foundation.
Yeah, it takes it to that logical conclusion there. All right, this seems very interesting. I'm glad to hear about this one.
Yeah, absolutely. So another additional benefit specific to private foundations is really the ability to make gifts directly to individuals. Where we talked about before, donor advised funds and other charitable vehicles are typically limited to making support directly to public charities or 501c3s. Private foundations within certain structures can make gifts directly to individuals. Really two overarching types: scholarships, and then what we refer to as GTIs, or grants to individuals directly. So let's talk a little bit first about scholarships. Scholarships are really deployed in two ways. A lot of folks don't realize this, but scholarships there's a big difference between what we consider a scholarship fund and a scholarship program. So a scholarship fund, an example of that would be, a donor going to a university, maybe their alma mater or a high school, and saying, hey, we would really like to make a contribution. We'd like to make the Smith Family Scholarship Fund. We're going to give you $25,000 a year to be then given to a student in line with maybe some of the values that we appreciate. A scholarship fund is fairly straightforward because a private foundation or another entity is making a gift directly to the school, a charitable institution, right? And then ultimately the onus of determining who ultimately receives that gift falls to the public charity or the school or the university or the church, et cetera. So the benefit for a private foundation is it's very straightforward and very easy. You're creating a scholarship fund in partnership with a charitable organization. But the downside to that might be folks who want to have a little bit more say and ultimately who receives that support from that scholarship. That's where we have scholarship programs. So private foundations can actually create their own scholarship programs. They typically need to be pre-authorized by the IRS. There's a process involved going to the IRS outlining how this program is going to look. But then once approved, private foundations can make gifts directly to individual recipients when they've determined the criteria and when they've determined the selection process. So they can feel, in many cases, that their contribution is landing in the hands directly of an individual who's going to be able to use that for predominantly education and education-related expenses through a scholarship. So scholarship programs and scholarship funds, very different things, both leverageable through a private foundation. And then next, Marche will talk about direct grants to individuals. So typically we see these for a couple of different purposes. We see them for hardship purposes, which are directly related to an individual recipient's financial need. And then we see support purposes. So these are grants to individuals that did not take an individual recipient's financial standpoint into consideration. These could be areas of, like I mentioned before, someone or a community who's lost their homes due to natural disasters, or there's an incredible amount of medical bills that need to be satisfied that are in line with a private foundation's mission. So going through proper steps, typically utilizing an application. Private foundations can make grants directly to individuals for support or hardship purposes, do not require advanced approval from the IRS, and organizations like Foundation Source can help make these types of strategies available to our clients. Okay, so I think we're getting pretty tight on time here, Marche, and I do want to leave a couple of minutes for some Q&A. Not a lot, but a little. I'll wrap this up by saying, specific to private foundations, I've said this, I might have said this on our previous presentation as well, but we kind of have this fairly cheesy expression in our space where we say that if you've seen one private foundation, you've seen one private foundation. And that being the theme of this presentation as well. What fits one private foundation, one family, one corporation's goals and standpoints are not going to be that of the next one that we see in line. This is a very personal decision, very personal choice, stemming from what are our goals down to what's going to be the vehicle that best suits my family, my corporation, et cetera. Ultimately, the impact and fulfillment that's generated from that charitable vehicle. So one foundation does not always equal one foundation, as I'm kind of making a point in the conclusion here, but it was a pleasure to walk through this today, and if there's any questions, we can jump in.
All right. Well, I do have a couple questions here, and then we'll give our attendees and you your day back. So here's a good question. So about the 5% distribution that's required, is that mean that they need to distribute 5% of the entire assets in the foundation every year?
Yeah, so the way the 5% minimum distribution requirement is calculated is it's actually based on the prior year's average assets within the foundation, right? So let's think about a family who's maybe creating a private foundation in July of 2020. They fund the foundation with $5 million. Is there going to be a distribution requirement for them for the remainder of this year? No, because there's actually nothing in the foundation in 2021, which is the prior year of the foundation. Now, starting in 2023, in this example, the minimum distribution requirement would be 5% of that $5 million. However, the $5 million was put in July, so it's really only been in there half of the year. So it's actually a prorated 5%. But it is based on the total asset value of the, private foundation based on the prior year's average assets. Good question.
And so kind of a follow-up question to that. So I'm assuming that's why financial advisors need to make sure that they're involved in this so that it's invested in assets that will grow the assets, because you do have to distribute a percentage of them every year.
Yeah, it is. It's a very strategic conversation, and this is something where wealth advisors are certainly going to want to be part of that conversation with the client, because that 5%, that minimum distribution requirement does carry a 5-year carry forward. So what I'll see for a lot of wealth advisors, especially with existing foundations that have been around for a couple of years, they can accumulate what's called an excess grant carry forward, meaning that maybe last year the market was doing really well. This is actually a true to life example that we're seeing right now, right? So maybe that foundation over granted. They made contribute or distributions that were closer to 7 or 8 or 9 or even 10%. Now the moving into a time where the corpus of the endowment is potentially down, and it can be a little bit more challenging to meet a 5% minimum distribution requirement because it feels like actually a heavier number from the prior year when the market was up. They may not have a true 5% minimum distribution requirement because they can carry forward the overage from the last year or the prior year up to 5 years prior to that. And maybe they decide, hey, you know what, we want to make sure that we're being mindful of the corpus of the endowment this year. So we're really only going to end up distributing 2 or 3% this year, knowing that they have that carry forward from prior years. So you're right, it is a very important consideration for all private foundations to make, because you do have to make your 5% minimum distribution requirement, no ifs, ands, or buts. And a benefit of a private foundation is there's no limitation on asset class, right? So you can, private foundations can hold real estate, and they can hold land, and they can hold private investment, private equity, private debt. Now, some of those asset classes do come with a different level of consideration when it comes to knowing what that value is. It's not just cash, or it's not a publicly traded security where you can get a direct valuation that day. So there are rules around how valuations are done with different asset classes. And it's also a really good reason to talk through with your qualified wealth advisor professional.
All right, great. This is a really great question. What if I'd like to create an endowed chair at my university? What would be the best way to go about doing that?
Yeah, creating an endowed chair at a university can be achieved not just through a private foundation, but other vehicles as well. It kind of falls into that that legal structured gift. Anytime there's something kind of being given in return, even if it's not a monetary reward or something like that, it could fall in specific to private foundations. It could kind of fall into that same naming convention, right? You're going to give a $5 million gift. In exchange for that $5 million gift, you're going to receive an endowed chair. You're going to receive naming rights for a building. This is where you definitely want to get your legal professional involved in making a gift of that type, because it's a structured gift, right? So it's typically going to come with some sort of, excuse me, some sort of signed off on document that outlines that type of gift. So it's doable within a private foundation, doable without outside of a private foundation, but definitely needs the counsel of a legal professional to be able to be successful with.
All right, I think we have time for about one more question here.
Okay.
I'm going to just choose one here. You talked about charitable expenses being some of the most fun for people, because can you talk a little more about maybe the impact of being able to spend that money and see where it's going, see where it's doing good?
Yeah, absolutely. And I did mention that because it's something that I particularly care about, but many donors and philanthropists will come to me and say, hey, Josh, I understand the importance of making direct gifts, and I understand the importance of supporting public charities with a gift directly. But one of the big benefits is being able to see some of your work being carried out, right? Like I said before, I have a family that I work with who, like many families, chooses to be more involved with their charitable mission. So they work in the clean water space, and they're very tightly tied with an organization based in Africa that they give support to regularly. Now, part of that support is for the board, for that family to travel out to Africa every year and be part of that mission. And they spend time, and they oversee where their grant dollars are going. Now that's resulting in benefit two ways, right? It's resulting in impact for that organization that's utilizing the gifts that they're receiving to impact clean water in their country. But it's also creating an incredible amount of fulfillment for that donor family, because they're getting in line with their charitable mission. Yes, they're utilizing expenses out of the foundation to pay for that, but they're getting to go over there and be on the ground and experience what their gift is doing for that particular community. So it's incredibly rewarding. I always say that In my personal opinion, the best way to be an effective philanthropist is to really meet in the middle when it comes to impact and fulfillment, because you might be doing an incredible amount of good work, but if you don't really resonate, if that doesn't resonate with you and you don't care about it, you're not going to be as apt to continue your support. Whereas if you find something that you really, really care about, and you can also create a great amount of impact in doing so, that's to me where you're going to be able to achieve the most as a philanthropist.
Well, that's a great note to end on here, folks. Thank you so much for attending. I want to thank Josh and the organizations that have worked with us to bring you this webinar today. For our attendees, look for an email soon for a replay of this event. And you're welcome to share that with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Bye, everyone.